I imagine people are just getting whiplash from some of these moves.
What a week. Just increasing volatility. Monday down 1.9%, Tuesday up 2.6%. And Wednesday down 1.9%. So really, in the end, the market not doing too much at all, but these volatile days certainly making traders and investors nervous. Now, volatility is usually not a good sign for investing, and usually when we do see high volatility, some of the strategies that work well are looking at quality or looking at momentum. So two strategies that work well when we are seeing increased volatility. If we have a look at the day today, there were a number of impacts. Offshore China, we saw the services PMI number, and we did see it reducing from the previous month to a read of 53.9. Secondly, retail sales here in Australia, disappointing. Market expectations was for growth of 0.3% in May. We just saw 0.1% growth, so just teetering on that edge of growth. And thirdly, oil prices. They shot up in Tokyo trade. We saw oil prices trading above 102 US a barrel. This is on the back of the tensions that we are seeing in Egypt and worries that we will see supply from the Middle East being affected. So all of these factors certainly impacting on markets around the region. And then, of course, the Aussie dollar. Let me just bring you up a graph of the Aussie dollar during the day. And you can see Glenn Stevens' speech took an absolute tumble. Glenn Stevens really just reiterating that the Reserve Bank taking that easing bias, and of course that Aussie dollar selling, not good news for the Aussie share market. In fact, in the top 20 blue chips, we only saw one stock trading higher, and that was Newcrest Mining. In the top 50 stocks, it was only two stocks trading higher, and that was Newcrest as well as APA. So not a good day on the market, but all in all this week, it's been a bit of a roller coaster, so it looks like it's just continuing.
A lot of the reasons that we're hearing when we see sell-offs like today, people suggesting, oh, it's the Aussie dollar falling, we've got offshore investors pulling out of their holdings here because they're concerned that they're going to take the currency hit and find better returns elsewhere. I mean, is it as simple as that, or is there more going on?
I think it is mostly simple as that. With overseas investors, they obviously make money just from the currency moves when the Aussie dollar is rising. And with the Aussie dollar falling, it's quite painful from a currency translation point of view. On the flip side, though, any Australians which have invested offshore, they'd be doing extremely well from the currency conversion. So we've been talking about that strategy for a while. But I think the other thing to be watching very closely is the oil price. Now, the oil price shooting above 102 US a barrel. This is the highest price that we've seen since May last year, so in the last 14 months. And high oil prices are important because they act just like a rate hike. So at a time when we are seeing global bond yields rising and the cost of financing increasing both on a personal as well as the corporate level, we're seeing oil prices rising as well. So the oil price is a thing to watch, and that could be a key headwind for the market. And we know just how quickly that can rise when we do see tensions in the Middle East. So just watching that.
What it is? Is that what's fueling? Is it the geopolitical issues, particularly around Egypt, that's fueling this oil price?
Definitely a key driver around the oil price, especially the WTIS at the moment, the West Texas Intermediate in Tokyo. The Egyptian tensions at the moment is what's behind that. And really, in the US session, we did see oil prices rising above 100 US a barrel, but settling just below that 100 mark. But in Tokyo today, we have seen it trading above 102 US a barrel. So I don't think it's global growth concerns which are driving up the oil price at the moment. If anything, it's geopolitical tensions that is really ramping up the oil price at the moment, and it's at a 14-month high.
The break, touch on some corporate news that was out, and you actually made mention of it before, Julia. Woodside seemingly catching the market a bit by surprise, cutting its guidance for production, blaming some technical glitches at Pluto.
I mean, this is a little bit unusual for Woodside Petroleum. We've gotten used to production upgrades because of Pluto coming online, but actually today we saw Woodside Petroleum come out with a production downgrade, so now forecasting between 85 to 89 million barrels of oil equivalent for the full year. Previously, they had been forecasting between 88 to 94 million barrels of oil equivalent. I guess the key thing to take out of this is that it is because of temporary impacts. There's about a 2 million barrel of oil impact from an unplanned LNG processing train needing maintenance, and the other one was a planned actually planned maintenance, but it went on for a bit longer than expected, so that's going to have an extra 1 million barrels of oil impact. So all in all, about 3 million barrels of oil impact. So it is a short-term impact. I guess if we have a look at Woodside Petroleum and where the value of Woodside Petroleum comes from, it's mostly from Pluto, the Northwest Shelf, as well as its growth plans going forward, and nothing's really changed in that regard. But the market not liking that downgrade, the share's down 3.4% despite that very strong oil price in Asia today.
Is it a stock you like despite this? And I mean, it's sold down pretty heavily, but it's no doubt caught up with some other broader issues as well. But as a stock for investors, is it one you like?
James, it's very difficult not to like Woodside Petroleum. World-class assets, a huge development pipeline, very profitable operations in the Northwest Shelf where it has a 1/6 share, as well as Pluto, which has been ahead of schedule. I guess one of the things that we might see with Woodside Petroleum, though, is cost pressures, and we have seen a number of those big projects around Australia seeing cost pressures. So hopefully, you know, with a number of coal mines shutting down, that perhaps some of those resources might be redeployed and we don't see some huge cost pressures in these LNG projects. But I guess that's one thing that the market's a little bit wary of. And the second thing is what it's going to do with its assets in Israel. So still just watching that, but most of the value for Woodside Petroleum really comes from Pluto and the Northwest Shelf at the moment, and then that development pipeline, and later on down the track we may see some uptick to valuations from its Israel assets that it's bought into.